All right, well, without further ado, I'll pass it on to Christina Wang.
Thank you. All right, good morning. I'm so glad I'm here. I want to join the chorus of thanking the conference organizers. It's a great privilege and honor to have our paper selected for this session. And I'm particularly appreciative because I've been a researcher most of my life, and this is a really very knowledgeable audience. In particular, you have the practical knowledge that I lack, and so I've been learning, and I look forward to learning more from our discussant and from the rest of you. Okay, the usual disclaimer applies. And without further ado, let me move in. Before I dive into the details, I just want to say a couple things, which is that this is work in progress. And you will see why, because of the data work. I feel that I have this grand vision for a mansion, but so far I've been pouring concrete in the foundation, and hopefully that will be a very solid foundation that I can build on. There are many things we want to do, and then the thing that I want to start with is that the motivation for this. So actually, I wrote a paper several years ago on using machine learning to fintech lending, analyzing fintech lending data. And so that is because as researchers, we recognize that after the great financial crisis, because of the various regulatory changes, banks, especially those large banks subject to more enhanced regulation, they seem to be retreating, and the non-banks have made a lot of inroads in consumer credit. And there are also some evidence that they seem to have sort of entered more in areas that previously were defined as underserved. I mean, we can discuss, how exactly to define that. And so I started thinking about what about small businesses, because we know, at least for a lot of the small businesses, their credit worthiness is often tied up with their personal finance, and so there's some overlap with the consumer finance side. And so we want to study what is the influence or impact of this expansion, of post-GFC expansion of non-banks into maybe small business lending areas. And so the goal of this paper, first of all, is to document. We use a data set that's probably as complete as it gets in terms of the credit that's going to small and private companies in the U.S. And we could call it sort of a U.S. credit registry, although it has its drawbacks. And then we want to study whether there is any evidence that the development may be different in areas that we oftentimes would consider underserved. And then in particular, we want to focus on the role of these new digital forward lenders and the role of regulation. And then at the end of the day, getting loans is to enable the small business to operate, to grow, right? And so we also want to see to what degree that this change in terms of the lending landscape to small business can we see some evidence in terms of the impact on real economy. This is just one, what I'm going to show you is just one, I treat it as a case study, which is to see how the evolution in terms of lending to small business after the financial crisis affected small businesses' access to the paycheck protection loans during the pandemic. There are many other applications that we want to kind of further explore. Once I finish, showing up the foundation. Okay, Very good. So our data covers from 2007 to 2021, and because of the pandemic, we kind of divide our analysis essentially into two time periods. One would be the pre-pandemic or pre-COVID, and then the other one will be during the COVID period and in 2021. And so first, regarding the pre-pandemic period, banks in particular, the stress test banks, so scale back their small business lending. In this paper, because of the data challenge, we haven't been able to exactly not for every single lender have we been able to kind of exactly pinpoint which bank that is consistently over time and across all the loans. So we made just kind of relatively, you can say, coarse separation or distinction. There will be the banks subject to stress tests. These will be generally with assets above 100 billion, and then the banks other than those. So of course, one major goal going forward is that we'll make further distinction within that set of banks that are not stress tests, which to separate out maybe the large regionals and the community banks, and look at their reaction and evolution separately. Okay. And so what we found that during this pre-COVID period, yes, large stress test banks scale back, but they didn't seem to do so more in those underserved areas. And so for the analysis so far, what we define as underserved, essentially you can think about as lower income or higher minority shares. Interestingly, that we found our definition actually corresponds somewhat to rural versus urban division, and also geographically. For example, the high minority share, actually a lot of it is in the South. And we found that non-banks here mainly, we think about two groups. One would be what we typically call fintech, although there's no standard definition in the industry yet. And then the other group, what we oftentimes called merchant cash advance lenders. So these would be essentially making loans, but then backed by the small business cash flow. Okay. And we found that bank lending, this is referring to stress tested bank lending, was definitely affected by the stress test capital shock, which I will define in detail later. So essentially, if they subject to a bigger capital shock due to the stress test, they scale back their lending more. And then the other banks and the non-banks kind of stepped in to fill that void, but basically kind of relatively similarly across different areas, not more so in low-income and high minority areas. And now, during the COVID period, this is mainly, we want to use it as a case study to see this pre-COVID sort of evolution of small business lending landscape in the US. How has it, in particular, this kind of increase in lending by non-banks, how much of that may have affected small business access to the PPP loans? A lot of you probably remember those really hectic days. And so, not too surprisingly, we found that indeed, that if a small business had a prior relationship with the non-stress test banks, meaning the smaller banks, it would get PPP loans 2 days faster or earlier. And this, I mean, for the ones that in the know, you will realize even though it's only 2 days, it's actually quite substantial. And it's very crucial because most of the loans were made essentially over close to a max 20-day period. And so 2 days is a fairly high fraction of that. And also for small businesses, as you know, they are usually not having a lot of liquidity. And so for them, to be able to get funding 2 days faster, and having the certainty was really lifesaver at that time. And so by contrast, if a small business had a prior relationship with one of those largest banks, actually it would get loan a little slower. Even more so if they had a prior relationship with a non-bank, they would get loans about 1 day later. And so what we took from this, and the other thing is that we also specifically look at depending on where the borrower is located, that if a borrower was from a low, moderate income area, actually we found in terms of the partial effect is that it's actually helpful to have had a relationship with some type of lender. So that means really having a kind of credit relationship is really important for people in those areas. And so the implication for this, just very quickly, is that as the sort of lending landscape develops, that for any government program, I mean, God forbid, that if we ever needed to do something similar to that, we should take into account what is the structure of the credit sources in the U.S. Okay, let me skip this. Suffice it to say that we stand on the shoulders of brilliant researchers. Many of them have done work on related topics. Now, about the data source. So actually, Yannick is not here today. So yesterday you heard one paper that talked about what's the impact of bank failures on small businesses. So we're actually using similar data. I just have a more nationally representative sample. So thanks to Yannick, I won't need to show you the forms that the lenders have to fill out in order to do that. And then most of our analysis will be at the county level. So we also bring in some county level demographic information, and we to calculate the stress test capital shocks, we use the public release stress test data, and then we also have data on every bank in terms of their regulatory filings. We're yet to make full use of that, but that is part of the analysis, and then we also have the PPP data coming from the SBA. Okay. And so let me just very quickly, since I'm running out of time, very quickly go over how we do the analysis. I'm sorry to say that what has taken us hundreds of hours and literally I had to go get a new prescription for my glasses because I was staring at the screen so many months. It only occupies half the slides. So that's trying to do the name matching to figure out which bank consistently in the data is doing the lending. So we distinguish between banks and those stress tests versus smaller banks. And then finance companies, as you will see, actually a really very important source of small business credit. And then fintech and those so-called MCA loans. And so the fintech and MCA lenders are more digital oriented, and basically you can do your application, they will do their underwriting, they will do the servicing basically all digitally online. And then our definition in terms of underserved so far, we are mostly using if your income in that county is in a bottom quintile relative to the state, then you're treated a low-income area. If your minority share is the top 20% in terms of the nation, you're treated as a high minority. Okay, so just to give you a sense of what you would see in the data in terms of the sources of business credit, and you would see that going from top and down is various types of government lenders, and the pink is nonprofit, and then come down, the green is MCA, and fintech is that thin line of yellow, and thin area of yellow. And then you will see that the largest three types of lenders would be, so these are from top to bottom would be the captive fintech companies, other banks, and then stress test banks. So they're, in terms of volume, they are the largest sources of this type of lending. But you can see they have been shrinking since after the Great Financial Crisis. Okay. Now, just to show you some stats, I know I'm really running out of time, that you can see that during this pre-COVID period, large banks have been cutting back, the most obvious. And then small banks relatively less so. And then those non-banks, especially the independent finance companies and the MC lenders and the fintech lenders, they've been growing massively, even though their overall volume is still relatively small. Okay. Okay. And then for the COVID period, actually pretty much all categories of lenders are cutting back, but government lending went up substantially, not surprisingly. And then the only growing sort of private sector is the independent fintech companies. Independent finance companies. Okay, so let me just, fortunately, I guess I had the foresight, I purged my slides of all equations and all tables. Let me just tell you the story very quickly. As economists, we always have to, I am very keenly aware, you have to identify, whether it's a supply shock, it's a demand shock. So we're using stress test induced capital shock to banks, to those banks, as a supply shock to see how other banks and non-bank lenders react. And so the main finding you will see here in these bottom part is that, yes, indeed, when their stress test banks are subject to a capital shock, they cut back on their small business lending. And then other banks and non-bank lenders step in to fill some of the void. Okay, and then during PPP period, as I have already discussed before, that if you had a prior relationship with non-stress test banks, then you would be able to access funding faster, whereas a prior relationship with a non-bank would delay you. And in fact, a prior relationship with one of those large banks didn't really help you either. And so the interesting thing, I think, is that in those low moderate income areas, that any relationship with the lender was actually helpful. Okay, so I think I'm done. I just leave this up, this basically really quick recap. So what we're finding so far is that there indeed has been this shift more, sort of a increase in non-bank lending. And the other thing that I want to point out, our data period ends in 2021. So when people, we don't have the current generation of AI effect in there. I want to make a very quick distinction that when people talk about AI, you should ask them, are they talking about machine learning prior to the arrival of these large language models? Because the technological advance is very different, and more importantly, the distinction in terms of how it would impact operations of smaller banks is very different. And so I think I would love to have that discussion further. I'm sorry for running over. Appreciate it.